Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We're up on CPI. I can think of no major economic report that I've ignored in the last number of days like this important inflation study. Greg Boutle of BNP Paribas will be with us. Tiffany Wilding will really give us direction, her wonderful work at PIMCO. But first, with his incredible schedule, we had to squeeze in here Patrick Armstrong. He's with Plurimi Wealth. For years with Templeton in Toronto, which is a magical place for me. Patrick Armstrong in the United Kingdom, thank you so much for joining us today. Are we at a point where the foreigners won't buy American stocks and bonds? Is something radically changed here?
I don't, you say won't, but I do think the winds are pushing against it. And Trump's tariffs are going to carve out some economic wins in the short term because Europe isn't going to respond immediately to the tariffs that have been put on them. But it is a risk for the United States that you've got global trade ex-US, and it turns into that kind of thing. And there's going to be really strong rhetoric from the White House because they know that's a real risk, that they just get basically disintermediated and their dollar becomes disintermediated as the global reserve currency if you push things to extremes. So I do think there's risks with this. I'm confident Trump is going to carve out some economic wins from this, but I think the consequences may be far greater, and it may be a sort of backhanded win for Europe and the rest of the world even.
Let's get out of the front of Tiffany Wilding, and we want to talk to you, Patrick, after this inflation report. The jobs economy analysis waits for May or June. Does this CPI report a current measure of inflation?
Well, it's last month, and we're in a different world. Some months go by and nothing happens. Some days go by and months and years happen. And that's where it feels like we are right now. The one thing the CPI may be able to do is it may give Powell an excuse to cut rates. He'll view transitory inflation as transitory, and he does have inflation probably on a downward trend with this print. So it may give him the impetus, if he wants to cut a little bit more aggressively, where his hands may be tied later in the year if we do have stagflationary consequences.
Patrick, where are you on the risk profile here? We've had just such a volatile number of days capped by yesterday's big rally. But we had a VIX at close to 60 just a couple of days ago. Where are you on the risk profile these days?
So I don't think it's a time to be a hero, but it was the time to incrementally increase equities. We decided on Monday. So we had a bad Tuesday when we added it, but had a really nice bounce yesterday. And anytime you're buying equities after a 20% sell-off, you're skewing the odds to your favor. And what we looked at the VIX when it was at 60, we said the only two times it's been like that before was the COVID crash and the financial crisis. And the VIX at 60 on Monday, this was a man-made crisis. And we knew an about turn could be not the end of the crisis, but really diminish the risks there. And that's why we felt a little bit confident to add risk. We actually started shorting the VIX in our macro fund on Monday with that premise.
Patrick Armstrong with us here for one more question. Patrick, just to cut to the chase, if I see the shock of a negative statistic on CPI, is that China exporting deflation?
I hadn't thought about it, but for that 1 month, there may have been a big jump in Chinese imports at lower prices as China wanted to get them into the US, buyers wanted to get them in ahead of tariffs. And that may have been a bit of a disinflationary and deflationary impact that's come out of it. Powell's going to treat it how he wants to treat it. It may give him the excuse to cut a little bit more than he would have otherwise. So I think if you are an equity bull, you'll welcome this news.
I mean, it's interesting to see. Patrick, one final question. We can do this, folks, we're coming to your commercial free. Is Ange done at Tottenham? I mean, Tottenham's not going to be relegated, but I mean, it's pretty ugly. What do you think?
I'm a Man United fan, and that's the only team that's doing as poorly as we are. So,
right.
Yeah, I can't throw stones when I live in a glass house. So,
comfort as Man United and Tottenham go down in flames this year. Patrick Armstrong, thank you so much from London. We'll get him on again for a much longer discussion. Now to the economics of the moment. Greg Boutle, BNP Paribas, with us in a moment, but Tiffany Wilding of PIMCO with us. Tiffany, month over month, is that negative statistic simply this crazy tariff-driven wall of unit import volume?
Well, just having a quick look at some of the details, it actually looked like the services side of the goods basket or of the consumer price basket was what was weaker in this report. And I think that just really speaks to the broader uncertainty that we had, even before this latest news. So travel services categories, hotels, airfares, there's been a lot of anecdotal reports about how, folks that were thinking about traveling to the United States are canceling those plans. Yeah. So I think it's a little bit of a calm before the storm, and you had higher uncertainty that was reducing demand for services in the U.S.
The tape improves. The VIX was up 3 big figures, now up to 35.53. Futures a negative 77. They were negative 100 here a bit ago, so a little better tape. Is that because, Tiffany, this gives talking points or chit-chat for Jerome Powell to ease rates without the pressure from the president?
Yeah, well, I mean, we still think there will be a price level adjustment that will have to happen on the good side. There will be some pass through from this. And I think the question is just how big will that be? And then the other question on that is how much weakness do you see on the services side of the economy as a result of these actions, that are impacting the prices of goods? And, maybe what this CPI suggests is that you will have a weakening economy on the services side that will contain some of this inflationary pressure. That obviously will allow the Fed, make it less awkward for the Fed whenever they're cutting interest rates.
Tiffany, have you guys over there at PIMCO taken down your GDP forecast for 2025? And if so, why?
We think there's a 50-50 chance of recession, and even with this latest reprieve, if you just take a step back, the effective tariff rate in the United States, just assuming that imports stay unchanged, has gone back to levels that we have not seen since the 1930s. And that's even with this 90-day reprieve. So you have a very big tariff shock that is impacting the U.S. economy. And we do think there will be some disruption on that, over the near term, and that will slow growth quite dramatically. And again, we think there's kind of a 50-50 chance of recession here. We think growth grinds to a halt later this year.
One of the great distinction here, folks, and I think in the chaos that we're living, I need to partition this. Tiffany Wilding is with Pacific Investment Management Company, PIMCO, and her responsibility is to a broad asset manager versus a market economist and, frankly, derivatives expert like Greg Boutle. So we get two different not views, but two different mandates here from BNP Paribas with us in a bit. And right now we stay with Tiffany Wilding here. We welcome all of you across the nation. Frankly, futures worsen out off the joy of 5 minutes ago. I got the VIX out 2.77, figures 36.39. Tiffany, have you seen it? And I don't want you to give away the secrets of PIMCO, but is it sort of steady as she goes as they listen to you, the managers, or is this a time for a radical reset of PIMCO?
Well, I think that we have been arguing, I think we've been on the right side of the recent volatility, because we were arguing late last year that the markets just, weren't focused enough on the sort of radical changes that the Trump administration was talking about. And I think that they've been actually quite clear about what they're trying to do. And I think everybody was just focused on various constraints, whether political, economic, or even legal constraints that would maybe impinge their ability to implement their policy, but they've just blown through all those constraints. And you are seeing the president basically do what he said he would do on the campaign trail. We think the 10% tariff across the board, that's sticking. Higher tariffs on China is sticking. I mean, they are very effectively trying to decouple the U.S. economy from China. And that's exactly what they said they would do. And so I think, take them literally.
So, Tiffany, I mean, we report a lot of stuff from China and a big tariff there. What does that mean for inflation for the U.S., do you think?
Yeah, I mean, we do think there's going to be a big price level adjustment that happens as a result of this. Now, I think from the CPI report this morning, one thing that it does suggest is that even if you're getting goods prices that are being set higher, as some of the cost, at least, is passed on to consumers, the services side, might be weakening at the same time, offsetting that. So I think it's, again, how much price level adjustment we get here, I think is the key question for the next, call it 6 months.
And folks, unfair question. Like if you asked me this question, you saw me, having a beverage of my choice, and you said, Tom, when? I'd say, I don't know. So let's ask Tiffany Wilding when. Tiffany Wilding, when does the slowdown of tariffs at Walmart, tariffs at Duke's bookstore, when? We got a text. Somebody said, stop talking about Duke. We're doubling the Duke conversation right now this morning. Tiffany Wilding, when for the consumer does all this agony click in?
Yeah, I mean, I think it's clicking in for businesses already, and they're trying to figure out what to do. And I think that you will have, you will have to have businesses that are raising prices at least somewhat. It will be, there will be margin compression, there will be price increases, and that will hit the consumer because their real incomes will just go down as a result of that. So I think you will see consumers that are getting hit from this. The other thing is just it's creating a lot of uncertainty. People could be more fearful of their jobs and things like that, and that could just result in more of a general pullback in consumption as well. Good
morning, Montreal. Major shout out to Bears and the team at Bank Credit Analyst. It's like Ed Yardeni, CJ Lawrence with Ed Hyman years ago. BCA is venerable. And Paul, they had a chart on labor yesterday out of BCA that was just shocking, the rapid deterioration. Tiffany Wild, thank you so much. Great to talk to you on this day of CPI. The tape was, VIX was up 3 big figures. We had a little bit of a, Paul would say, quiescent move here. We've given it back a little bit. The VIX 36.45. Futures now back negative 100. This is Standard & Poor's futures negative 100. John Farrow tells me the Dow futures negative 608 are worth noting as well. Even BitDog down 1,000, down 1,200 points rather. 81,000. There's a little bit of tension here, to say the least. We welcome all of you on YouTube worldwide, including in Paris. Bloomberg Surveillance, it's brought to you by IBKR. Will the U.S. Consumer Sentiment Index, will it exceed 70 in April 2025 at IBKR? Forecast Trader, the yes was recently at 29%. Start predicting today at ibkr.com/forecast. Last trading day for this contract, May 13th. Thank you, IBKR, for your support. I've really anticipated this because Greg Boutle takes equity strategy, folds it into the derivative space, wraps it around a true international view for the BNP Paribas. Is that like the French way to say it? That come close here?
My French isn't outstanding, if I'm honest.
They have the best lunch in Manhattan, is what I know. Please advise us here how you prepare for a Monday research note. A completely unfair question. It could change 3 times. But how are you framing the tone of your weekend note?
Well, I think you have to be prepared to write it and then rewrite it 3 times in between now and then. So I think the thing that we're trying to do is put in context some of the moves around some of the flows, and then think about some of the headline risks. But then ultimately, how does that translate into what we're going to see over earnings season?
Okay, earnings season. It's tomorrow, right?
Yeah.
Indeed.
Come on, we don't have, I guess we sort of do on this earnings season, but there'll be no guidance, right?
No, so I think like the backwards looking data, whether it's the CPI we've just seen, payrolls from last week, or the earnings prints themselves, hold little value, I think, at this point. But any qualitative read, commentary, tone from management is going to be looked at very closely.
So what did you see on your trading desk? What did you hear from your clients over the last, 24, 48 hours? Because yesterday was just crazy. The bond market the night before was just incredible.
Do you know you can't get hired at BNP Paribas unless you know all the Greek letters? Alpha, beta, gamma.
That's what I
epsilon, rho.
derivative stuff.
Samro, the whole thing.
So we think some of those Greek letters were certainly responsible for some of the magnitude of the moves yesterday. So obviously the move itself is triggered by the headline, the tweet, but the magnitude of that move is driven by the fact that we do have a short gamma complex in the market. What this means is that there's re-hedging needs for when the market moves, both lower and higher.
I opened the show this morning on this. People got to go out and re-hedge. Folks, you and I are not re-hedging at home. We're trying to pay the rent. But in the institutional space, people are protecting themselves, and now it's so expensive to protect yourself. You really can't re-hedge, can you? How you doing it?
Well, I do think there are opportunities to use the optionality complex. We look at the headline levels of the VIX and certainly where it peaked and they got incredibly elevated. But one anecdote that I would give you, at the close yesterday, you could look at the NASDAQ and the market options implied probability of it getting back down to yesterday's lows by the end of next week was more than a 10-to-1 payout. So I think there are interesting asymmetries that you can find.
So where did you see on your desk yesterday the buying, or where did you see the activity yesterday?
There were different pockets. So we have an equity positioning indicator that tracks institutional positioning, and it got to absolutely washed out levels before yesterday.
Really?
So institutional positioning is very clean. But what we have seen is just consistent dip buying more from the retail complex. So if you look at net ETF flows in the US yesterday, you saw more than 10 billion of inflows on the day. At the same time, some of these rebalancing flows that we've talked about have been a dominant force in the market. So we think there was more than 55 billion driven purely from the short gamma complex yesterday.
Short gamma. We have seen institutional capitalization in positioning. I've been trading for 40 years. I have no idea what that means. What does that mean?
Yeah, so in terms of capitulation in positioning, we track various metrics. Some of the systematic funds are easier to track. Things like CTAs.
Right.
We know that those funds move to a net short position. Volatility target that manage capital based on the levels of volatility have become extremely de-risked. But you can also look at things like hedge fund positioning. You can use things like the CFTC futures data. You can see that there has been a massive degrossing.
Okay, there's been a massive bill degrossing. Okay, great. But the answer is, where's the blood in the streets? Without getting, I don't want to mention names here, that's not appropriate. But when somebody has the cliche, there's blood in the streets, where do you and BNP Paribas suggest there's been some real damage?
Well, I would say that actually, when we think about the US equity market, and particularly the volatility market, it has been maybe a little bit more orderly than it seems on the surface. So when we look at our positioning indicator, it had been trending down a long way prior to the tariff announcements. And we think about this announcement, nobody was expecting the magnitude of the moves, but this was a known unknown in terms of a catalyst that we do think people were hedged for. So when you look at the Thursday move, I think that's quite indicative of actually a calmer options market than you would expect. We got a big move higher in the VIX Thursday, but what we do is we look at the size of the VIX move relative to the size of the S&P move. And in normal calm markets, what you see is the VIX go up 1.5 points for every 1% decline in S&P. And that's actually what we saw on Thursday. You compare that to other pockets of risk, and that move is much more explosive.
And folks, stay with us here on this. There's a little bit of jargon we're doing here, but we're thrilled to have Greg Boutle, BNP Paribas, with us. You were cautious in the bull market emotion of the recent year or two or three, and now we've got the market back to a Greg Boutle level.
Yeah.
Do we now have an equity value in the market where you always thought we'd be, or do you need to see some catharsis here to really step in long?
I think it really depends on ultimately what do you think the growth outlook is. So if you believe that this volatility and this news flow in terms of tariff isn't going to derail the growth outlook, then a 20% correction, which is where we got kind of highs to lows, is at the extreme of what you get without a recession. However, when we start looking at where do we think earnings could be this year, if you've got a 255 number for S&P earnings, that's a 5% year over year growth. That's not overly bearish. Put that on an 18 times multiple, that would get you around 4,500. So I'm not sure that there's a really obvious value case to make for US equities here.
Do you have a belief in European equities?
So I think one of the things we saw at the start of the year before this episode of volatility was that there was undoubtedly rotation starting to happen from US into the rest of the world. Now, clearly what has happened in terms of trade and tariff has derailed that in the short term. If we do get back to a more stable market, then I do think there is potential for that rotation to continue, but not whilst we're in a volatility environment such as this.
All right, Greg, Tom, if we take the Bloomberg Surveillance Show over to London, do we do a day trip to Southend-on-Sea?
I think it would be extremely
And what
pleasant.
would we do there?
I think you would take a walk down the seafront. Maybe you go and try and catch a game, have a beer. I think you can have a great time.
Southend, it's on the estuary, Tom.
It is on the Thames estuary,
of the
yes.
Thames River.
It's out past Charles Dickens' place.
I think so. I mean, it looks great. I'm looking at it right here, and that's where Greg's from. So I figured we'd ask a local here.
Take a walk down the pier. It's very pleasant.
Have you ever been to Dickens' house in Rochester, the one that he
I haven't.
bought late?
I haven't.
It's supposed to be magical. It's
Oliver's on the beach for
hugely
coffee.
extant of what Dickens was when he was there in 1860, 1870.
Okay.
Have you ever finished
the Castle Pub.
Have you ever finished a full Charles Dickens book, or did you use the United Kingdom Cliff Notes?
Well, maybe I listened to the audiobook.
Yeah, there you go.
Greg, thank you so much, really, and congratulations on the work. The derivatives base here, folks. The French, and this goes back hundreds of years. There's exquisite mathematical integrity out of the French banks. This gets them into trouble sometimes, but good morning to the Paris banks for all that they do, particularly using the Bloomberg and derivative equity measurement, as we did from Mr. Boutle as well.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Our interview of the day on fixed income, without question. Ian Lyngen is with BMO Capital Markets. He writes the densest, tightest, most in-depth note. Paul and I were talking about it. You get a paragraph from Ian Lyngen, and like you're lucky you get through it at lunch. It's so intelligent. He's won, just in the II surveys, folks, I think he won 11 consecutive years.
That's pretty good.
It's like Juan Soto and walks.
Right.
I mean, Ian just keeps doing it with BMO Capital Markets. Ian, on the inflation report, you're brilliant. Quote, this is the lowest in over 4 years. Is it a one-off pre-Trump tariffs, or can this disinflation continue?
Well, I do think that what we're seeing is that the Fed was reasonably successful in finally getting inflation back to, or at least toward, where they would like to see it. It does set up a good departure point for absorbing the incoming price increases that we are sure to see. So if anything, today's report suggests that we won't retest the pandemic highs in inflation simply based on the trade war.
I can't say enough, folks, about the holistic work of the Bank of Montreal within your entire team, Ian, and with your leadership here. How many Fed rate cuts? What's the degrees of freedom that Chairman Powell has?
Well, the events of this week have bought him a little bit more flexibility. I think that we are going to see 2 rate cuts this year, one in September and one in December. The only way that we actually see something in June or earlier is if we see a re-escalation of the trade war that pushes equity prices even lower.
So, Ian, what did you see in the bond market over the last 36 hours? Because, boy, we had some big moves there. And what did you see in the Treasury market?
So in the Treasury market, we saw a very sharp re-steepening of the yield curve because there was a lot of concern that the trade war would lead to a buyer's strike in the 10-year auction. And the fact that we had such a strong sponsorship for the 10-year auction really bodes well for the Treasury market as an asset class. And I think that that speaks to why we are stabilizing here with 10-year yields well below 450 and certainly no concern of retesting 5% anytime soon.
I mean, we had a dash to the Ian Lyngen lower yields. Ian, you've been way out front on a vector of lower yields. With this turmoil in Washington, I guess when it's over, do we reaffirm your disinflation, lower yield, higher price environment?
Yes, I actually think, if anything, the turmoil in Washington increases the chances of a consumer-led economic slowdown, and a recession is disinflationary on a forward basis. So once we absorb all of the tariff increases, I think we'll have a consumer that is in a much different, much less compelling place than it was during the pandemic. And so I'm worried about disinflation in 2026 and beyond.
Recession, is that in your call, Ian?
It's not our baseline scenario, But the events of the last 2 weeks certainly have increased the probability from, let's call it 10% to 35 or 40%.
Belsky once told me he reads every word. I mean, help us out here, Ian. If we get, a 3% 10-year, 3.x% 10-year yield, we get disinflation, and is that good for Brian Belsky and equities or not?
I think that it depends on the departure point for the equity market at the moment. If we come into the event with the S&P 500 at 4,700, that's going to be a net positive and stocks would rally into the end of the year. If we're at the peaks and the market comes to the realization that we're going to be facing an economic slowdown of some magnitude, then that will initially be bad for stocks until the Fed gets involved.
Ian, how do you think the Fed kind of looks at all the news coming out of Washington, D.C., all the tweets, all the, the side press conferences, the little gaggles and things like that, which kind of really, really move the market on an intraday basis? How does the Fed deal with that, do you think?
Well, it is a pretty challenging environment for the Fed, to be sure, but it's not the first time the Fed has had to absorb and react to social media posts and announcements. So it isn't as dramatic as it was during Trump's first presidency. However, I do think that Powell's stance of wait and see has only been reinforced by the developments this week, because if we don't know what the tariffs are ultimately going to look like, it's very difficult to base any monetary policy decisions on the what ifs, and that's what Powell is struggling with at the moment.
In this 9 o'clock hour, with the market opening here in 20 minutes, we welcome all of you on your commute across the nation. We welcome you on YouTube. Thank you so much. In your office, at your home, subscribing to Bloomberg Podcast. Your interest growing each and every day. Good evening on the Pacific Rim and over to India as well. Just humbled by the South, particularly Southern Asia. I mean, in Japan as well, I've had some anecdote, but really, thank you so much in the South Asian, India, in Malaysia, Singapore evening. Greatly, greatly appreciate your attendance. Paul Sweeney and Tom Keene, we are commercial free in this hour. Thrilled to bring you Ian Lyngen of BMO Capital Markets.
Hey, Ian, honestly, I don't pay attention to these treasury auctions. There's smarter people that do that for us. Ira Jersey, Lisa Abramowitz for me. What happened yesterday with these auctions, and why were they important?
So we had a strong takedown of the 10-year auction. The risk was that in retaliation for some of the higher tariffs, that foreign buyers would step away from the Treasury auction and it would tail dramatically. In fact, we saw a strong stop through, which really reaffirmed the market's perception that there are going to be buyers of treasuries, particularly in an environment like this with so much uncertainty.
Ian Lyngen, thank you so much. With BMO Capital Markets, of course, we protect the copyright of all of our guests. Look to his important research note at the Bank of Montreal.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now from Laffer Tengler Investments, Nancy Tengler. I saw Professor Laffer writing yesterday, maybe it was a couple days ago, joint op-ed about we're going to get through this and we're going to get through it with a budget responsibility. Nancy, we're all exhausted. Take us away from the politics. And when do we get back to what we recall a few years ago is normal?
I know, Tom. I went to bed at 5:30 last night, and I slept all the way through. It was
you great. Slept all the way through?
For you.
I'm going arithmetic. I had 2 hours sleep, then 4 hours sleep. And last night it was like 5.5 hours sleep. Yeah. So after your beauty rest, what do you see?
So I feel like this was an unforced error. Go Red Sox, I was told to say.
Right.
How about the pitching?
Exactly.
About it.
I think, look, you expected the president to come out and declare victory. He did. All the proxies are declaring victory. But really, this was one of the sloppiest policy rollouts I've ever witnessed in my 40-plus year career. It didn't, I don't think, advance the ball to the extent that we wanted it to. And the repercussions will be felt for some time. So if you look at Google reinforced or restated, yes, we're going to use we're going to implement our CapEx budget. Microsoft pulled the factory. these are very long, as you know, time horizons to build a factory and to get parts. 68% of of manufacturing GDP is imported parts. You can't fix that overnight. So I think we're going to continue to see this ripple through the markets. And I wouldn't jump in quickly. I'd take my time and add to names. I do think we come out the other side.
Laffer-Tengler is the most interesting. I've been a defender of Arthur Laffer. A lot of critics going after him. He and I will argue about the calculus of the Laffer curve and where the tangent is on the curve. Forget about that. You got Yale and Stanford economics wrapped around your creative writing and psychology. It's a really interesting mix out there. And when you say you don't get what they're doing in the White House, that's important.
Yeah.
What's Art Laffer say? He's got to be as appalled as you.
I mean, I can't speak for him, but I can say he's pretty annoyed. So I just spoke for him.
We're missing in action. Where's the Secretary of Treasury? Where's the Secretary of Commerce? Where in God's name is a Penn PhD, Kevin Hassett, to advise them within the prism of Laffer-Tengler economics?
They have to get through Peter Navarro has been the problem.
Oh, come on.
I mean it.
You really mean it. They got.
I do. And I think it's really interesting how he's been MIA from the media, and that's a good thing. And now they just need to get Howard Lutnick off the air and put out Bessent, put out Hassett, and have the president speak to his own policy. But I think it was so poorly rolled out. I don't think they knew what they were doing until the day before. And I was told they used ChatGPT to generate that chart, which was ridiculous. All of us were going, what the?
No, we can't say that on radio. You can say that over on Bloomberg TV, and they go. Here on radio, you go to jail, so be careful. Now, Paul, let me get one more in here because I think this is just absolutely critical. What does the president have to do with comfortable conservative economists? The giant Glenn Hubbard of Columbia University, exquisite Kudlow, who's a legit economist over at Fox, all of them. What does the Tengler, Laffer, Kudlow, Hubbard crew, the great Ed Lazier, who we miss every day at Stanford, what does your cadre have to do to get past Navarro to the president?
I think we've sort of done it in the media. I think there's been a drumbeat, and 10% isn't as troublesome as these arbitrary slapped on tariffs. But I actually think that the president believes a lot of this, and just like he believes the trade deficit is bad. And those of us who have been around for a while would say trade deficits are good if it's driven by prosperity. So 10% would be more like a flat tax, and I think that would at least stop distorting behavior.
Down -700. Surveillance apology. I'm sorry, Paul, I took too much time there. I was all wound up about the moment there, about the bodies at the White House. Nancy knows them all, that's why.
Nancy, have you guys changed your risk outlook over the last several days here as we've had to deal with a lot of this tariff volatility?
We started changing it, Paul, in after the market peaked and we started getting sell-off. So we moved a little bit more defensively. We're still selectively buying tech names, mostly focused on the software side of things, less focused on the hardware side. We still believe AI is instrumental. You saw Spotify headline that said, no more new jobs unless you can prove it can't be done with AI. So I think those are important. Walmart came out and reaffirmed the full year guidance. They're going to generate they're our poster child of an old economy company that has pivoted to the new names. So we've added names like Accenture, or added two names like Accenture and Netflix, Spotify. These could be more defensive names if we do go into recession. But I think we're into economic deceleration as opposed to a potential recession.
What do you expect to hear from the C-suite this earnings season? I mean, I think a lot of folks are concerned that there's headwind and there's really earnings risk out there, that the estimates that are out on the street need to come down, and maybe come down pretty significantly. Maybe that's already priced in. I don't know, but are you concerned about the earnings season coming up?
I don't think we're going to hear much. I think we're going to hear delayed guidance. I mean, I would do that if I was in the C-suite. Why would you give guidance? But Walmart was interesting at their investor day because they did reaffirm the year. They just kind of gave a wider range on the quarter. So I think what we heard last earnings season around tariffs was that the CEOs were confident they knew how to navigate. I don't think they were expecting maybe some of what we got, but they could be, expecting what we've got now. So, but it is a 90-day pause, and I think we have to be aware of that.
I'm focused on the labor economy. It's maybe the greatest disagreement I've had with the supply side crew. I think of, folks, this is esoteric, but real business, economics, Carnegie Mellon, Freshwater, Charles Plosser, Philadelphia. I've got some real issues with the job generation. A guy named Summers, who's from the dark side, and Olivier Blanchard, the giant, will talk about hysteresis, where just the labor economy just falls apart. Do we risk a new permanent higher unemployment rate with all this carnage?
I think we could, Tom. I mean, so far, we've seen
Excuse
the
me,
numbers.
that's a headline for the day. Tengler and Summers on the same page. Continue.
I found myself agreeing with Elizabeth Warren the other day.
On what? Please, on what?
On maybe Congress should be a little more involved in tariff policy. Yeah. But I think we could, and I think it could be accelerated by AI, because we are seeing, like at our firm, we're using AI software to listen to the calls for us, and then we can go in, the earnings calls that is, and then we can go in and focus up when we want to. So that saves hours and hours a quarter. And I think you'll start to see more of that. More in our firm, it's more thinking, less just analyzing, headlines. Right. And I think that's important. So I think we're hearing that. We're hearing AI. Last quarter, we heard the theme was we're hiring less on the low end or entry level, and we're hiring less, or we're keeping less middle management people, and that spanned across sectors. So I do think it's a risk, but I also see an expanding, growing economy if we get deregulation, or once we realize the effects of deregulation and the tax cuts, if we get them.
What are we doing in the bond market these days, fixed income? Are we taking credit risk? Are we sitting in the treasury market? Where are we going?
So in our muni portfolios, we've built callable portfolios and kept the duration below a year. So we've been getting a little over 4%. As you know, the muni market melted down a couple of days back, but it started to come back. On credit, we're not taking credit risk at this particular point. Although the spreads have expanded, they're still not in danger zone. So we've been parking in the short end of the treasury market for clients where we're expecting to extend duration later.
To finish up here with a broad philosophy, and this goes back to, I remember I was in the Hanover Inn in Dartmouth with a guy named Newt Gingrich, and we were talking about that night in 1994. I'm sitting on the couch.
Remember it well.
Dan Rather's talking to me with CBS. Nobody's prepared for this. And all of a sudden, folks, supply side was running Congress. Where is your movement, Dr. Laffer's movement, in 10 or 20 years? I can't figure it out.
I mean, let's hope that it's not forgotten. He has the Laffer Center, and he continues to put forward his policies through the Laffer Center. Got Young Americans, or Foundation for Young Americans, that focuses on it and is teaching young college students about the movement. But I do think at some level it is common sense, and it will continue if we get congressmen who can stand a position. And I think that's what's been so disappointing for me, the falling in line on either side all the time. Like, we need fresh thinking. And supply side economics worked, and it could work again.
This has been wonderful. Don't be a stranger. Nancy
Thank
Tengler,
you.
folks, iconic, with Laffer Tengler.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Too short a visit right now with Jordan Rochester. We're going to have him on for a longer visit here in the coming days, but we just had to get him in, writing with Mizuho, their FIC macro strategy. Jordan, in the currency market right now, it appears that China's affecting some form of depreciation. If they do a yuan renminbi depreciation, what does that mean for the dollar and for America?
Typically, it would mean a stronger dollar. It usually would mean, therefore, you offset the impact of tariffs. But the tricky thing is that we've not really seen broad dollar strength after tariffs were announced. It actually breaks most of the textbooks in terms of tariffs usually mean that the dollar has to appreciate because the terms of trade of Europe and everybody else is weakened. But what we've seen is this whole situation led to a seizing up of the financial markets. Dollar exports received usually in Asia weren't being received, as now everyone's been trying to wait out the tariffs and try and hopefully get a better deal down the line. And so you've not had the same recycling into US treasuries and into US equities. So you've seen broad dollar selling as a result. You've seen much less dollar buying on the equities and the fixed income side from foreign investors, thanks to all of this.
Jordan, what does a 125% tariff on Chinese goods mean for the U.S. economy? Everything, it seems like we use, comes from China at some point. What does that mean for the economy, do you think?
It's a level of tariff that I think is so high that it makes it very difficult to say that you're going to continue to import from China at the same rate. But really, what's going to happen is a lot of rerouting of trade from China to Vietnam, to Cambodia, to Singapore, and it's going to have the lower tariff rate than the 125. So the US is still going to import from China. It's just going to have a bit of a sightseeing trip along the way. And so for the US economy, this is still going to weigh on growth. It's still an effective tax hike on the economy, but it's not as bad as the sticker price.
Is that cheating? I mean, what we're going to hear in the House is China's cheating because they're running the Jordan Rochester Mizuho merch through Vietnam on the way. Is that like, that's just, to me, that's like normal decision-making in trade, or do you buy the idea, Jordan Rochester, that it's cheating?
I don't know if the word cheating, it's just what happens in business. If you think about oil sanctions as well, there's lots of, the EU still buys a lot of natural gas and oil from Russia, despite there being sanctions. So there is lots of these examples in international trade where the aim seems right, but the actual outcome is different. And I think really the sort of 10% floor that Donald Trump has set for everybody is a better example of how to avoid that problem of rerouting. There is no one to reroute through. That is at zero. And I think this applies to the trade talks with the UK, Japan, and everybody else. I don't know how they're going to get them below 10%, because then you'll just have rerouting through Belfast from Dublin. That's the sort of thing that will happen if we go any lower.
So, Jordan, what is the fixed income, commodities, credit, macro strategy call out of Mizuho today after what we learned yesterday?
Every day is a new day. If you'd asked me yesterday, I would have said flattening is the best trade. And I didn't expect a 30 basis points flattener in just 30 minutes after I said it in 2s, 10s for the US. So I think what you're likely to see is Eurodollar is going to be quite range bound, because the ECB is probably going to cut rates more aggressively than the market prices, and the Fed will not cut rates as aggressively as the market prices. We have about 85 basis points priced by the year end for the Fed. We don't think they're going to cut at all. So I think that we could see some dollar strength at some point when the Fed makes their reaction function more clear. But I think the better trade, if you want to be short the dollar, is short dollar yen, because I think the Japanese will continue to raise rates this year slowly. The market completely whacked that lower yesterday before the good news, and we had no hikes at all priced for Japan. We've started to creep back in for higher rates in Japan. That's going to continue, I think. And I think the US will put pressure on the Japanese to raise their rates as well and to have a stronger currency. So dollar yen to 140 is another view. And the US 10-year, 5% by year end.
Okay. Jordan, that sets us up. We need to get you out in the next couple of days for much longer. Come over
to New York,
even
too.
A 2-blocker. If he's in New York soon,
we'll
let's
grab
get
him.
Jordan Rochester in studio as well. He is with Mizuho.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us now, Kona Hake. So happy that she could be with us today. Kona, in this crisis, I should say with ED and F Man, iconic in commodities, which soft commodity is of the greatest study for you this morning?
Because it seems to be a US-China trade war focus right now, I guess it would have to be soybeans. China imports heavily from the US. Well, it had been. It managed to divert away from the US market in Trump's first term during the first trade war. So I guess it's less reliant on the US as it was before, but it's still big imports. Today, it gets a lot more from Brazil. So I think that's going to be the big trade flow move that we're going to see as a result of these retaliations.
For all of you across the great Midwest of America, this is the conversation of the day. Kona Hake, how easy is it for Beijing to say, Donald Trump, see ya, we're going to Brazil for the marginal soybean?
Pretty easily, actually. In fact, right now, most of it's coming from Brazil, and I think that shipment's going to happen in a more rapid force. The seasonality is such that that's going to happen right now as we speak. The US export season doesn't happen until later in the year in September. So we have a long time to go before we actually see how these tariffs pan out. Because, 6 months is a long time in this trade war, right? Things could be completely different by then. So until now, China's getting most of its soybeans from Brazil. Brazil stands to be a massive beneficiary of any trade war arising from US and China. And they're taking advantage of it. So, yeah, I think that China has managed to diversify a fair amount already.
So, Kona, we're not really sure where we are with this trade war here. We had a little bit of a pause yesterday, the president stepping back a little bit on rest of world here. What's the commodities play here in a world where trade tensions are so high? Where do you go?
Oh, it's not good. I mean, commodities ultimately is a risk asset. So whenever you have macro risk off, commodities will be sold off, as we have seen in this last week, which was unprecedented volatility. Crude oil is tanking, as it should be, because the economic outlook in any trade war is always so negative. The first thing that gets impacted is negative energy demand. So that's impacting all the energy commodities. Metals, likewise. Softs and agricultural commodities have weathered the storm better than the other three, I guess, particularly because I think that, at the end of the day, imports will still have to happen. It's just a question of trade dislocation. The one thing that tends to win always is gold. It is the classic safe haven, and it has reached record highs. It probably will go higher again. So I think, long gold all the way, but crude oil, at some point, it starts getting very cheap. I worry about Donald Trump's plans for drill, baby, drill, because he was... you need $70 oil to get any kind of investment in the U.S. for shale oil.
Paul's up $63, 31.43.
Yep.
That's a wow statistic.
That is
gold.
A wow statistic. So, Kona, when you think about gold, is there a valuation call here for gold at all? Is there a way you look at gold and think about it relative to maybe other commodities, whether it's the stock market, the bond market? How do you think about valuation here, or is it just buy it?
You buy it. It's one of your diversification portfolios alongside other safe havens like the Swiss franc and the Japanese yen. Traditionally, US bonds and the US dollar would have been in that basket, but today, arguably, it's less in favor. So gold still has that intrinsic value that people like. So I think it definitely has more upside to go. But, at some point, once we start getting more of a feel for where negotiations are going with bilateral negotiations, and eventually, and I do believe at some point, China and the US will come back to the table. At some point, you start looking at the metals and energy again.
One final question, Kona, an ED&F man with just the heritage that you have. If you were in Beijing today, what's the commodity where China has power or leverage over America? I'm sure it's some odd commodity. I don't know. Which is it?
It's the critical minerals. It's the rare earths. They have complete ownership and control over that. And that is one thing that the USA needs badly if they want to build this whole electrification and transition energy side of things, which Donald Trump wants, because those minerals have been actually exempt in these tariffs. So yeah, I think that's something where China definitely has leverage. And then the sheer population. China has been a very export-oriented economy. Today, China is going to have to shift into more domestic consumption-led economy.
Right.
So that's being forced upon them, becoming a bit more like the US GDP. And once that happens, that doesn't reverse rapidly. So I think then this structure China is going to be forced upon will have dramatic changes on the way the world second largest economic power starts behaving with the rest of the world. I think really interesting times.
Just brilliant. Kona, thank you so much, particularly on soybeans there. Good morning to Brazil, listening on YouTube. Subscribe to Bloomberg Podcasts in South America. Kona Hake, ED&F man.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.